All right, how is it going, everyone? Welcome to another episode of Forward Thinking Founders, where we usually talk to founders about their companies, their visions for the future, and how the two collide. But today is going to be a little different. Today, I'm actually talking to someone on the other side of the table. I'm talking to Turner Novak, who is the general partner at Gelt VC, and we're going to be talking all about fundraising and what the perspective is from the venture capitalist who's getting pitched all the time, with the ultimate goal for founders to understand on a deeper level how fundraising works and what pitfalls to avoid, etc. So with all that said, Turner, welcome to the show. Thanks for coming on.
Awesome. Thank you for having me. Super excited to be here.
Yeah, I'm very excited to have you on as well as the first edition of I think I'm gonna launch these on Mondays as like VC Partner Monday, something like that. So I'm very excited for you to be the first person on here.
Cool. Yeah, I hope I can live up to the high expectations.
Yeah. No, I honestly, because you're a person who is in the position of writing checks and you do this for a living, whatever you say is going to be living up to expectations, because like you're the perspective that so many founders wants to understand, right? So kind of to start, I guess the first question for you, kind of high level to understand a little more about you kind of as a VC is, generally what type of VC are you? Are you late stage? Are you early stage? And to start, like, what sectors do you look at, just to kind of start things off?
Yeah, so to start things off, sectors, we are fairly open. We're really opportunistic. We really kind of stay away from things that we don't know, which is not very knowledgeable about biotech or blockchain, crypto stuff, and don't really know much about kind of cannabis and CBD. Those are really the only things that we don't do. But other than that, any type of consumer or enterprise product, doesn't even have to be software. I'm pretty open to taking a look at all those things. The way I think about it is there are many people out there who are a lot smarter than me and who are probably a lot harder working than me and can figure out things that I have not thought of. That, it's kind of tough as me as a VC being super early to really be thesis driven. I'm really more of just like idea driven. I think a lot of people have, they're kind of market first or team or founder first investors. I kind of skew towards market first, but I'm really idea first. What's the big idea that you have, and how is it solving a problem that's out there? Really early. So typically, the kind of checks that we write are anything between 25 and 250,000, and usually those are you're raising around that's between 500,000 and maybe like 6 million total ballpark valuation of the company. 25 million or less. And a lot of, depending on where you are, what part of the country or what part of the world, the stage, whether you're pre-seed, seed, series A, that can all kind of be different. So it's kind of, I don't really like to brand myself that way. I'm really just open to hearing people's ideas really early and seeing if there's any way I can help. And, if it's something that I really want to be involved with for, probably be like 10 years, really, in a lot of these cases. So we're pretty opportunistic how we think about things, and typically, I have some theses that I kind of makes me more interested in taking a look at things, but I'm really open to really just the idea. Really the best venture scale outcomes come from things that people weren't thinking about. I think by the time it hits the blogs and the fortune cookie tweets, everyone knows about them. There's a lot of competition. So I really like to invest before the blog posts and before the fortune cookie tweets. That's when I'm interested. I want to invest in the stuff that people are going to be writing blog posts about in a year or two. That's kind of my strategy.
And if you want to invest before the blog post, before the podcast, etc., how do you hear about ideas early? I guess what I'm asking is, when you think of deal flow, is it mostly all introductions? Is it all cold? How do you think about getting in front of these talented entrepreneurs who have great ideas?
Yeah, it's honestly all over the place. To be totally honest, there's kind of a process. As a VC, so kind of getting in, I know you really want to kind of understand from your perspective, you want me to talk about a little bit more nuanced, we can read about what people have written or publicly spoken about on podcasts before. But for me, it's a lot about just trying to build relationships with the kind of people that open up deal flow for you. So kind of getting towards the second level. I mean, with VC, it's very much relationship driven. So I really just try to build good relationships with other investors, and then also other founders and just smart people working on cool things and thinking about things differently. So whether it's founders or just people who are working in tech, or even people who are just experts in a certain industry, they might not even work in tech. They really understand CPG and food, or they really understand education and they work at a university. They have no interest in tech. Just kind of learning how to think about things from them, because you can maybe get an idea from them, or they're talking about a problem, or you realize that there's certain ways that the world works from talking to those people. So in terms of getting deal flow, it can be from other VCs. Sometimes founders reach out, pretty open and available online. I mean, my email is on the website. It's in my Twitter bio. I think my location on Twitter is actually my email address. So I'm pretty open to people reaching out to me, and really try hard and, take pride in like looking at everything and trying to respond to everyone and being as helpful as I can. It's not necessarily something that's probably going to scale forever, but it's kind of the classic startup mantra, like do something that doesn't scale, and figure out how to scale it later. And right now I'm definitely in the point where, I'm just trying to be as hands-on and helpful as I can for all that kind of stuff. And then I'll find something just proactively, I guess one example, I've been super interested in kind of the fragmentation of enterprise SaaS and kind of time spent in the workplace, and trying to figure out things that kind of bridge all this fragmentation that we're kind of seeing in workplace tools. And found a really interesting founder working on something there that I'm going to invest in. And that was kind of just from me seeing what she was doing and reaching out to her. But yeah, I mean, that kind of stuff can be really lucky. A lot of things in VC is the companies that you find or that come across your inbox. It's a lot of luck, and then being able to see it and just being in the right time, not being on vacation, having the capacity to like really dig into it for 2 hours and make a decision, not being in between raising funds and being able to write a check, or just the mood you were in when you read an email or took a call. I mean, it's very much emotion driven in a lot of cases. There's numbers or whatever, but when you get super early, it's just an idea really, and like, were you sold on the team? My kind of take is team super important, but I really value market as well, because I think if you come up with a good idea, you're a smart person, and people, and you're a hard worker, if you can execute and you can kind of show that it's working. So I really don't put too much weight on who someone is or their background. It can be important, but it's not everything. I think it's really more of what you've done and how you think about the world, and how you think you can fix some of the problems that are out there. So yeah, I'm pretty open. In answer to the question, pretty open to inbound stuff that's cold. Talk to a lot of different people, and really I think it just comes down to effort and just being willing to, as a VC, just pay attention and care and try to help people as much as I can.
So there are probably founders listening that are all across the spectrum. There could be the founder, or how about the aspiring founder that wants to start a company? Let's say they're listening to this and they get an idea, like, great, I have an idea, perfect, let me email Turner for money. And then on the kind of opposite side of the spectrum, there might be a bootstrap founder that's working on a product, for a year, and let's say they're like 20,000 MR, like they're deep in. Well, I mean, that's still early, but you know what I mean. How should the former think about getting in touch with you and contacting you and building a relationship with you, versus how should the latter, does where they're at in their entrepreneurial journey matter on how they try to build a relationship with you and get in touch?
Yeah, it definitely, it's the same and it's also different. I mean, I think for me, it's really just understanding what people are working on, and if there's an interest on my end in learning more. And one of my big things is I don't really like wasting founders' time. So if I just am not interested in the product, or maybe don't agree with them, and don't think it's a good problem to be working on, and I'm probably wrong too. If you look at VC's hit rates and success rates, like they usually make their own calls. Yeah, and I'll just, I guess, maybe a good time to edit this one. I'm trying to think. I don't know. It's a tough question to answer.
I guess the reason I asked the question is
maybe start over, ask the question again, and I'll try to give it a better answer.
Sure. Yeah, no problem. Cool. So there's people listening that are on all stages of startups. One just has an idea, and you just mentioned you're into ideas. If you have an idea, great. Let me email and I can get funding. Like, that's very like wide-eyed view, and maybe earlier like in their startup career. Then you got someone that's like, been doing it for a year or two, and they're making real money. Do you, because you're pre-seed and seed, I guess, do you look at these two the same, or are there different ways that you'd want the person that's really early to approach you versus the person that might be more in your sweet spot? Or is revenue even matter for your sweet spot? Like is it just idea at this stage?
Yeah, that's a good question. And it's hard to answer in a really succinct way. So I think ultimately in a VC's mind, they want to think, I'm going to give this person money and then the idea is going to work. Really? So that's a hard question to answer in someone's mind, and it can be different with everyone. So I think it's really about having a good, I don't want to say pitch, but just a good understanding of what you're really trying to tackle and what you're trying to do. What problem are you solving for people? How does your solution that you're building, whether it's a product, a service, whatever it is, how does it kind of fit that need? And why are people tripping over to give you money? Whether you haven't launched yet, but you are convinced that everybody's going to want to use your product, or whether you have, $100 million in revenue already, like why is it going to continue? So I think really early days, it's, what's the initial traction look like or going to look like, and how can you prove it and convince an investor that it's coming? Or if you're already a big business, like what is your core product? What kind of strategic value does it give you in your customers' eyes? And what other products are you going to be layering on over top to kind of generate more revenue from your existing customers? Or why do you only have 1% of the market and you're going to capture 10% of it and kind of 10 times your revenue over the next couple of years? It's a very open-ended question of like, what's going to convince an investor to take your money? And it depends on the investor too. Some people might come in and, they say, we think that enterprise software is done and no one's going to use cloud anymore and everyone's going to go back to on-premise or something. And that's probably not right, but someone might have a certain view that just doesn't really match with what you're pitching, and that's okay. And that's why there's thousands of VCs. There's probably, I don't even know what the number is, how many VC firms are out there, or how many different funds, but there's a lot. So as a founder, that's awesome, because one person might say no, but there are hundreds more that probably fit your exact thesis, like pre-seed enterprise SaaS in San Francisco, that write a specific check size and that lead around. So you have a lot of options. And I think it can be really tough to get people to pull the trigger and convince them to invest. But I think now is an interesting time. There's just so many different people that are investing. So there's at least options. And, there's not very many people necessarily that maybe lead around. So maybe you have to kind of scrape together a round of a bunch of angels or a bunch of smaller funds if you can't specifically get someone to come in and lead and take half or the full round. But yeah, I think there's definitely a lot of nuance of how you convince someone to give you money. And it can be very easy and straightforward. It can also be a long, grueling road. Always happy to try and help people as much as I can, because I know it can be really tough. I mean, I'm a VC. I'm technically fundraising my fund right now, and it's hard. It's tough. So
how does this is going to be like a somewhat tactical question, but
okay.
So you're raising a fund now, which means correct me if I'm wrong, which means you're pitching potential LPs to give you money so you can invest into the next Gelt VC's next fund. How do you, is your check, are you pitching like a potential different check size for to these LPs that you want to start writing out of the next fund? I guess let me rephrase the question. How should a founder, me, knowing that potentially a VC I'm pitching is in the middle of raising a fund, does that matter to the founder at all? Because a VC might still be investing out of the previous fund, or is that does it matter to a founder, and should they play their cards right in that capacity?
Yeah, I think it's important to know. And I mean, typically you can just ask, do you guys have capacity to write checks right now? You can probably ask strategic questions like, what was the last investment you made, or like, when was the last investment you made? So if you're a founder and you're strategically, you ask this question and the VC says, so our last investment was in June. And you go on their website and they say, oh, we try to invest in, 10 companies a year. And their last one was in June. They haven't found any good companies for the last 6 months. We're talking in January right now, so 7 months. So yeah, there's definitely some strategy you could definitely think of if you're a founder from that sense. Yeah, and I think usually VCs, I mean, maybe some people will lie to you. I don't know, but for the most part, I think people are pretty open. If you say, do you have the capacity to write checks right now? VCs are usually, if you're having a candid, private conversation, they'll let you know exactly where they're at. Our fund is 60% deployed. We have a $100 million fund. We have $40 million left to invest. We'll probably invest in 4 more companies over the next year. And we're raising a second fund. They might be able to give you a little bit of insight on that. We save about half of our fund we use to do follow-on investing, which is basically once the companies, if you're a founder and you're doing really well and you're going on to raise another round, VCs love it if their existing companies are doing well and they know you very well and they can put more money in. And that's typically where most of their returns come from as a VC, is from the companies that really start to do very well. So yeah, I think as a founder, it's important to just not be afraid to just ask and just say, like, where are you guys at? Like, are you able to write a check? Yeah, and I personally usually am pretty open about my check size, where we're at, how big our fund is. Sometimes I proactively will say, I'm thinking about writing $100,000 check in this specific instance right here with you, or I'm thinking about maybe doing a $50,000 check. I think it's good to ask though. I think it helps give as much visibility as you can into the fundraising process as a founder. I think that's an important thing to do, is be pretty. I think for some people, maybe you have a really good product and the money just comes in, but in a lot of cases, you really have to say, okay, I'm gonna talk to investors for these 3 weeks. I've lined up 100 conversations. I'm gonna do like 10 a day or whatever it is. I know how much I probably need from each each fund. I'm going to give everybody updates as I go. That's kind of an interesting thing. I mean, usually as a founder, you're giving investors a deck with some charts that probably go up and to the right. If you can give them updates every week on your round of like, hey, we're at 200,000 book now. We're at 500 out of the million. We're at 750 out of the million. It's an interesting strategy and a way to do it as a founder. Generate some FOMO. VCs have a lot of FOMO. They really do. So if you can generate that as a founder, I've seen it work really well, kind of tactically to kind of close out rounds, is to get people to move. So yeah, that's always a trick and something to keep in mind. But yeah, I think overall, just be open and just ask questions. Don't be afraid to, ask what you want to know. And I think if it's your first time doing it, maybe talk to other founders. I think talking to other founders is a really good way to kind of get their take, because I've never raised money as a founder before. So I don't know exactly what they go through. As a VC, you can try to empathize as much as you can. And like I said, I'm raising a fund too, so kind of know, but I really don't. So yeah, I think overall, a lot of different ways to go about doing it.
So you're raising. So actually, I'd like to take what you just said and turn it around, because I'm just curious. Like, so you're raising a fund right now. So let's say I have a company, which I don't. Let's say I do, and we're talking at this moment in time, and I asked you, hey, like, are you writing checks? Like, do you write checks at the same time you're raising a fund for the next round? Are you on hold? Like, what would you tell a founder if I was pitching you right now? What would you tell them?
Yeah, so typically, the way that most most of these like fund vehicles work. Uh, you might have raised your first fund, you're trying to invest it. Maybe you're guys having conversations with people about your second fund. You haven't finished investing in the first one yet, but things are going well. And I mean, that's kind of what I mean right now. I mean, I'm just always talking to LPs and investors. I think there's certain rules too on like fundraising guidelines on like how VCs are. That's why you don't see VCs like posting on Twitter or like writing on their website like, "Hey, we're fundraising right now." You have to be specific. Like if you have an open, I guess I'm not sure the exact phrasing for it, but yeah, I mean, you can't really be talking publicly about these investment vehicles that you're raising. So for me, I mean, I'm just always talking to LPs and trying to have those conversations. It's a little bit different than maybe founders because you you don't necessarily have an open structure. Like I can kind of take money at different points in time, whereas typically what you'll see with founders is they spend a month fundraising and then get back to work for 12 months. Whereas for me on the LP side, I mean, they're just kind of very long conversations. Some people I've been talking to for over a year, just kind of getting to know them and getting to trust me as an investor. A lot of these are very long-term relationships for VC. So for a founder, you might have a company. It's going to take you 10 years from the day you found it to the day you sell to someone or the day you go public, or if things don't work out. And maybe those VCs will come back and invest in your next company. Who knows? Definitely happens sometimes. But for VCs, you're raising a fund one, a fund two, a fund three. You raise 10 funds over the course of your career. In theory, you really want to build relationships with LPs where you generate the returns for them, and they want to come back to back each one of your funds. Because typically in most cases, if you have a fund below, we'll say a threshold of like $25 million, most of your money is going to be coming from kind of just high net worth individuals. You reach a certain threshold where you maybe start raising from more institutional investors who, they have either an endowment or a foundation or a pension. They're managing $100 billion for teachers in Kansas or something, like their retirement plans. And then once you pass a certain threshold, maybe that's 100 million, you can really start to talk and have conversations with them. And that's always nice. You have a LP relationship with somebody who, they're the chief investment officer of the North Dakota police officers retirement plan. They have a $10 billion portfolio and they invest with you over the course of 5 or 6 or 7 different funds. And maybe you keep returning the money to them. They put a little bit more in each time and it gets a little bit bigger. So it's a little bit different from the way that founders would think about it. I guess as a founder, maybe you don't hope to be fundraising perpetually for 50 years. You hope to reach a point of sustainability. You go public, or maybe you sell your company and you go back and start a new one. And so maybe you do go back to the same investor. So there's a lot of similarities. There's a lot of differences too. So yeah, I guess the way I think about it is as a VC, you have founders that you're really working with. You're also working with LPs. You're also working with other VCs. It's a lot of sales. It's a lot of analytical. And for me, it's really fun. And it's also sales, it's analytical. I try to help with recruiting. I'm always super like hands-on and try the product. So it's like I said earlier, my process is not something that's super scalable right now. I have to figure out as I kind of scale up and get a little bit more established as a VC what I'm going to do. And I honestly don't have the right answer to that right now. I'm still learning. So it's definitely day one for me still in terms of writing checks into startups, and hopefully I'll be doing it for 50 years. So
Yeah, definitely. I have another question relating to something you mentioned earlier, which is reinvesting money back into your winners, because that's where most money is made. I'm curious if you can go into the nuances of this. I actually don't have full understanding, but I know like there's a pro rata where if you invest under pro rata rights, you have the right to keep your kind of investment position and equity position, throughout all the fundraisers. But this is where I might be wrong, but like that is not necessarily good for founder. Like, can you kind of go into what the ways that you can invest in round after round, and ways that may be more VC friendly versus ways that may be more founder friendly, if there is such a thing?
Yeah. Yeah, I think the way I think about it is really, if you're a founder, you create a company, let's say there's one of you, or there's two of you, or three or four, you own 100% of the company yourselves, the founders, so whether it's one or four people, however many. When you raise money from outside investors, you give away part of your company. So, I mean, typically maybe in that very first round, you might give away anywhere from, depending on if it's a friends and family angel type round, if it's an institutional round, you might give away anywhere from 5 to 20% of the company to outside investors. And really, every time you raise money, you're giving away part of the company. So maybe your company's valued at $100 million, but you only own 10% of it. So your stake is only $10 million. Or your company's valued at 20 million, but you own 50%. So your stake's still worth 10 million on paper, if you really want to think of it from a money standpoint. So I think ultimately these decisions of who gets what, it comes down to the founders and what they want. But sometimes having certain VCs in, so kind of stepping back again with VCs is one of the things we're kind of seeing is, and really stepping back again a second level. So the returns that a lot of LPs are expecting, kind of the Kansas teachers retirement plan, the endowments that are giving all the money to the VCs, the returns they're expecting in the public markets, looking at this, the S&P 500, a lot of them expect the returns to be very low going forward. That's been the case for a while, and that hasn't actually happened. I mean, I think the S&P 500 was up something like 25% in 2019. I actually don't know what the final number was, but it was up like huge. No one saw that at the beginning of the year. So a lot of these institutional investors who are giving the big dollars to the VCs they want to get out of the public markets because they think they're overvalued. Whether that's right or wrong, that's kind of their thought process. So a lot of them are putting money in the private market. Some of it's real estate, some of it's kind of private equity buyouts, like larger funds. Some of them are VCs doing kind of like tech venture type stuff. But what's happening is more and more people are putting money here. So if I'm a VC, if I'm Turner, I have a $5 million fund, I want to go out and raise a $100 million fund or a $1 billion fund. My current strategy of writing checks that are $25,000 to $250,000, that doesn't make any sense for me when I have a $1 billion fund, because I wouldn't get to invest it. Like, I have to make 20 investments a day to invest my whole fund of $1 billion over the course of 2 or 3, 4 years. So we've just kind of seen VCs have to write larger checks. It's kind of a function of, I'm sure people have kind of seen the round sizes that founders are raising at all these different stages are just getting larger. And it's because VCs have more capital to deploy. And the returns have been good. So LPs think the public markets are overvalued. I'm getting good returns from my VCs and from the private markets. I'm going to put money there. So kind of tying it back to how it works as a founder, sometimes you'll be talking to a VC and they're like, yeah, we want to invest, but we want to put in $10 million. And like, we can only invest if we can put in $10 million in the round. So it can, and that's not always the case. Some people are very negotiable if I think about it, but it can affect just everything. I mean, there's downstream effects. You've kind of seen, I think SoftBank is probably the extreme example of everything that I just talked about, where there's some LPs that want to put 10 billion, or in the case of some countries, $42 billion into this like venture tech buyout asset class. And they kind of created this asset class that kind of is top down saying, okay, we're going to try to invest $100 billion in this tech startup asset class. And we're kind of stretching what the asset class really is. And it's having effects on everything else. And we're kind of seeing how it's changing a little bit. People are seeing, maybe this wasn't quite the right approach to doing it. But honestly, I think if LPs think that they can't get returns in the public markets, they're going to keep finding other ways to do it. And maybe it goes away from VC. Maybe they look overseas. Maybe they go to crypto and Bitcoin. Maybe they, look to like space investing. I have no idea what's going to come up over the next decade, but it'll be really interesting. And I think ultimately, a good way to think about it is just what are the big institutional investors thinking about, and how are they kind of deploying their capital? Because everything's going to flow from that eventually in terms of what the VCs have and what they're investing. So that was a long answer to your question, but hopefully that was helpful.
Yeah, no, it's good. It's good. And I have one final question for you before we wrap it up. Thank you so much for coming on and giving us the VC perspective. The last question is, and it's kind of a general question, but what is just one thing or one or two things that you wish founders pitching you or pursuing you or trying to raise money from you, what you wish that they know that they may not know, or what's something that you wish founders in general knew that they don't know?
I think the biggest thing is it's honestly, as a VC, you see a lot of different ideas and companies and pitches, and it's really hard to be right. I mean, most VCs say no to everything. You know, you say no to 99.5% of the companies that you talk to. So, no, it's just something to think about as a founder. Like, chances are this VC that I'm talking to is probably going to say no to investing in my company, and that's okay. And it's really a numbers game. You just have to be persistent and just, whether it's talking to more people or being more focused in your approach or getting more feedback from people, it can be really tough, and it's a long road for sure. We definitely see instances where sometimes a product sells itself, sometimes it sells itself to investors. I think it can be really helpful to, do a little bit of background on VCs, to understand how to pitch them if you really, really want them as an investor, and also not put a VC on a pedestal. Like, in most cases, more about your company than a VC does. So they might have feedback for you or suggestions, but you're the expert on your company. You know more than the VC does. And like I said, in a lot of cases, their decision to invest or not will probably be wrong. Most VC investments, I don't know what the most recent data is, but in general, they lose money. So they'll invest, they'll probably be wrong. They don't invest, probably end up being wrong too. So it's definitely, and don't take things that VCs say as the gospel. A lot of VCs, they're investors. They're not company builders or salespeople. Maybe they have experience. Maybe it's a little bit outdated. Maybe they're still in the trenches. You never know. So I think in terms of thinking about talking to VCs and investors, I think it's just, don't take anything personal. Like, most VCs generally try to be helpful and nice when they can. And it's tough. There's a lot. I mean, it's tough. It's like any other job, you're trying to do. I think there's a good newsletter written by a VC called Drinking from the Fire Hose. So there's just you think of one of those fire hydrants where you knock it off and just the water sprays everywhere, and you're just trying to stick your head in there and drink some water. Kind of hard. So that's definitely how I think about it. And it can be like that as a founder too. You're trying to figure out, what do I work on? What do I build for my customers and for my users? So I think, and don't be afraid to just ask VCs for, I guess, to help. Like, can you introduce me to someone? Most VCs are happy to, and even not VCs, even other people. Just ask for stuff, and you'll be surprised at what people are able to do.
All right. I fully agree with that. Asking, just making the ask is half the battle, to be honest, in my experience at least. So thank you so much for coming on to the podcast and being the first VC to ever be on Forward Thinking Founders. I appreciate you coming on and giving us all the insight that you've given. And just, best of luck finding all future unicorns. And just again, thanks again for coming on.
Yeah, awesome. Thanks for having me.